Welcome back, traders. And today we are going to be diving into one of the most important foundations of trading. In the last lesson, we talked about price action and market structure, and I'm sure you guys really learned a lot from the first lesson, the second, and the third lesson. Now we are moving into the fourth lesson, which is like the most important aspect in technical analysis. Excuse me. So today, like I said, we're going to be diving into one of the most important foundations of forex trading, which is support and resistance. Now, if you understand this lesson very deeply, it's like, how should I put it? Like putting on glasses for the very first time. Yeah, you actually will be able to see the market clearly. You'll be able to understand the market properly. Now, every winning trader, whether they trade forex, stocks, crypto, or gold, any type of market, they use support and resistance in some forms. They might call it other names, they might call it this, that, but at the end of the day, it's support and resistance. Why? Because these levels they reveal exactly where the battle between the buyers and the sellers is happening. So in this lesson, we are going to be covering a lot of things. Just the main aspects under support and resistance. We are going to be covering how to correctly identify support and resistance levels, the power of supply and demand zones, how to use trend lines and channels for structures, and how to avoid the deadly traps of fake outs, and the secret power of psychological levels like round numbers. So by the end of this lesson, you won't only know how to mark your chart, but also how to trade with confidence around these key levels. So grab whatever you want to use and let's get into it. So now let's start with the basics. Horizontal support and resistance. Now, support is an area where the market has stopped falling before and started going up. And while resistance is an area where the market has stopped rising and started going down. Now, so that you won't think I'm saying gibberish, let me go to the chart and show you exactly what I'm talking about. So now you can see this chart on XAUUSD Gold, which is the market I trade the most often. So now, if you look at the chart, let me just make sure all this one. You're going to see a lot of movement. But now, if we should zoom out properly, now you're going to see like the market moved. Let me just draw the path. The market moved up like this, fall back, and moved like this. Now, this is on the 5 minute time frame, but if I should zoom up to the 1 hour time frame, you see you see the movement more properly. Like you understand the movement more properly on the 1 hour time frame. Now you can see the movement. It's it rose, it fell back, then it broke out, and you already understand that this is called an higher high. This is an higher high and it's on the higher time frame. So this is a swing high, this is a swing low. This this swing high, swing low. I think you understand the concept of those ones. So now, where is the support? Where is the resistance? Now, price went up, it broke, it came down, then it broke this level. Now, this is the resistance. This part that was broken is the resistance, and this part that it came to this level and it went up back is the support level. Now, for a support level to be valid, some say that you need um 3 point touches. But me, I say you don't really necessarily need 3 point touches. You only need 3 point touches when you want to like do some flipping and some stuff like that. But like on a norms, this level right here is a resistance level and this level is a support level. Meaning if price should come back to this resistance level, it's going to become a support for it to bounce back. Maybe I should, for you to understand exactly what I'm saying, let me go back in time, trying to look for. Now look at this example. Let me just draw it out. Look at this example. Now price went up, it came back, it broke this level. Now was a resistance level. It was an higher high. It's a resistance level. Now price broke that higher high, which is a resistance level, and then came back to retest and became a support. So now this resistance now become support. But let's say for example, price didn't break this place, but it came back and it started pushing back down. Now that's when it's become a resistance level. But this one is resistance become support. Now there's also support become resistance. And you get the idea now. Let's assuming let's assuming price price went up, came back, went up, came back, went up, came back. Now what do you notice about this? Price refuses to break out from this level. Now what do we call this level? This is what we call a resistance level. Let me This is what we call a resistance level. Price came to this zone, it went back, it couldn't break out of that zone. It came back, then it came back to that same zone, but it couldn't break out of that zone. It just went back down. It came back again and it couldn't break out of this zone. It came back. Now this is a resistance level. And the same for here, support a support zone. So do you understand it? Now this one, like I said, resistance become it hasn't become support yet until it comes back to this zone, until it comes back to around this zone before it becomes resistance becomes support. Now, if you want to like visually understand support and resistance, you can just go to the line charts. You can just go to the line chart and see you're just going to see all this thing and you'll be able to understand that okay, those sharp edges that looks like V and A, you'll be able to understand where is support and resistance. So the chart might just look a little bit messy because it's it won't give you a natural something like this. So that's why I said that if you want to understand it properly, just go to the line charts and then you'll be able to understand the mechanics of the support and resistance. Now that's not all about support and resistance though. Now, like I said, I mean, think of support as the flow in your house. It's old price up, and think of resistance as the ceiling. It holds price down. Like I already showed you in the example, support it's when the market breaks out of its zone and it comes back to that zone, but couldn't like the support acts like a floor. So for example now, if you bounce a ball on the floor, it goes up. If you throw a ball to the ceiling, it comes back down. That is how the mechanics of support and resistance is. But here's the thing, price doesn't respect exact numbers, it just expects areas. So when you mark support and resistance, don't think of it as just a thin line. Think of it as a zone. So it doesn't respect just one number. For example, like this line now, price price might come back exactly to this line, and it might not be exactly this line. It might be this zone. Let me draw it out. It might be this zone. So it's not exactly that is this exact line. No, it's like a zone. Support and resistance is like a zone, not a line. So do you understand now? So for example, now if a pair like Euro USD has bounced around, like let's say a price like 1.0800 multiple times, that's a support zone. But if it keeps struggling to break above like 1.1000, that's a resistance zone. So do you get the ideology? So now the more times that a level is tested, the stronger it becomes. So the more like a level has retest, come back, go up, come down, like the more that price has come to that level most of the time, the more it becomes stronger. So if buyers defend the level again and again, it means there's real, demand there. But remember, this every level eventually gets broken. Nothing holds forever. So that's why you have to be careful when trading the market. For example, now in this example that I gave here now, you might think that, oh, price is going to come back. mm, might think that, oh, price is going to come back to this same zone. But if you know concept about liquidity, you know that price might not respect this zone again. It might break out of this zone, and then what do? You wait for a retest, then you take your entry. Or sometimes probably like sometimes probably from like his after breaking out, then from somewhere here from this zone or this zone, just as in somewhere here before you get a massive movement to the upside and stuff like that. So just know that eventually it's going to break. Nothing holds forever. So now open open any chart of your choice. I'm going to be using gold. Now try to look for a place that price has bounced like 3 times, where price has bounced like a zone where price has bounced like 3 times in the past, and just zoom out like on any time frame, 1 minute. Okay, I'm going to use 5 minutes here. I'm going to use 5 minutes. So now just zoom out and look for where price has bounced like 3 times. Then draw a rectangle just to or draw a rectangle to illustrate the zones instead of just a line. Yeah. So for example, this present one now, you can see that price, this consolidation zone, price broke out of it, came back, broke out, I mean went up back, then came back to this same zone. Now what would you be expecting? You'd be expecting that, okay, price would want to come back to this zone, and then you can take an entry, and then expect price to go up back. Now what do we call this? We call this a support zone. Now, like I said, this support and resistance, they are zones, not just a line of price. No, they are zones. Now, where does supply and demand come in? That's what we are going to be looking at next. Now, notice how like price doesn't just like touch the line perfectly. It can wick above, it can dip below. For example, now this one dipped below, this one didn't enter fully, but it was still in that zone. Now, that's why zones are better than just exact lines, because don't be the trader like who panics because price just went 5 pips below the line. For example, this one, it's just the overall area that matters. Do you understand? So, for example, now you can set a limit here, a limit here, a limit. You can set. Let me show you. You can set a limit at the middle. You can set a limit here. 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 Just set where can carry your risk. For example, now let's assume I set a long position somewhere here. Now the risk here is about 60 pips, and let's assume my risk to reward is like 1:2. So now this is a good trade. This is an example of a good trade. I could even leave it and see how it plays out. But note, price might not respect this zone. Like I said the other time, price might not respect this zone. It might come back to an order block or something like that. I don't want to say some this thing. Those ones are um advanced listing. For example, price might come back. For example, now, like my strategy, I just draw the Fibonacci from this zone right here to the higher high, from the lower high to the higher high. Then I wait for price to come to this 0.79 retracement level, and then I set a long position at that zone. And then what I do is wait, or I can set a limit order, and then my target is just this. Sometimes I can target more than that. I can have more take profit. So, like I said, there are different strategies. I'm just teaching you this support and resistance so that you can apply it to your trading strategy. For example, now I might be like, okay, I'm very sure of this entry because price broke out of here, it came back, it broke out. Now, what can we say about this level? It was a resistance level before. Now, what can it become? A support level. If I should go to the line charts, you can see it here. If I should draw it, if I should draw the zone for you. Now, what do you notice? It collides with this my 70, even though it's not exactly, but it's very, very close to this my 79% percent retracement level. So, what do I expect? I'm expecting that price will come back to around this zone and then move up back. Now, I'm going to actually take this trade. Actually, I'm going to take this trade because I'm very, very sure of this trade. Very, very, because if you should also go to the higher time frame, you can see that the trend is positive. And let me remove this. And if you should notice, there's a fair value gap here. Now, I don't want to like, there's a fair value gap here. Let me just draw out the fair value gap zone. Now, what do we know about fair value gap? Though you guys might not know, but fair value gap, which is FVG, it's imbalance in the market where the weak of the former candle, like there's, how should I put it? There's like a space between the wick of the former candle and the wick of the next candle. Like the high of the former candle and the low of the um what am I saying? Take for example three candlesticks. The wick or the high or the low of the first candle, for example, the high of this candle wick and then the low of this third candle, there's a gap. That gap is what we call an imbalance or a fair value gap, a a buy side or sell side inefficiency, whatever the term is, but it's generally known as a fair value gap. Now, this is another confluence for this my trade. Now, since this fair value gap is around the zone of this my 79% retracement level, now I already have two confluences. One is a support and resistance zone. Two is a fair value gap on the 1 hour time frame, and on the 1 hour time frame, the trend is positive. Now, what can I say about this trade? This trade will obviously or might come to my entry and continue to my take profits. So I'm much more confident about this trade. So now let don't let me digress too much. Let's just come back to what I was saying. Now you can learn one or two from from what I just said now about this my strategy. You can just try to implement it. Fibonacci retracement. Fibonacci retracement. So now let's upgrade the idea. Horizontal support and resistance show us levels, but supply and demand they show us why price reacts. Now, supply zone is an area where sellers came in aggressively before, and a demand zone is an area where buyers came in aggressively before. Now, these zones are usually formed by big moves. If you see like a very sharp move or a sharp rally after price touched a certain area, that's a demand zone. And if you see a sharp drop after price touched an area, that's a supply zone. For example, let me show you a demand or yeah, a demand zone. For example, this is a demand zone. This is a demand zone. This is a demand zone. These are demand zone. Now, to know if it's a demand or a supply, there's something we call rally based rally. Now, let me go to the whiteboard so that I can understand. That's why I said that some of these concepts they might be complex, but just listen closely and you would understand it as much as possible. Now, for demand, we know that is um a it's it's an equivalent to like a support zone, right? So now to know a proper demand zone, there's what we call rally based rally. Rally based rally. Um drop base drop base okay, let me I think I'm mixing it up. Rally base rally. Now this is the demand zone. This consolidation here is the demand zone. Demand. Then we have this rally base rally. Then um drop drop base rally. Drop base rally. Also a demand zone. Demand zone. Then we have rally rally base drop. Now we already know that this is a supply zone. So do you get the rally base drop? Then the last one, oops, the last one, drop base drop, drop base drop. Now, if you know these patterns, if you can spot these patterns on the chart, you will know where a valid demand and supply zone is. So a demand zone, rally based rally, and drop based rally. Okay, or we can put it like this: a demand zone, the um end this thing is a rally. A supply zone, the end this thing is a drop. So now, if you go to the chart now, let's try to identify a demand and supply zone. Like I said, if you want to like see the chart properly, you can just go to the line chart. Now, what do you notice? Rally base drop. Now, what can you say about this? This 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 zone here is a supply zone. A supply zone. Now, you can use some of these strategies to actually flip accounts, like just for quick flip movements in the market, especially with gold. Is gold you can use to like flip and stack properly, very well, stuff like that. Now let's look at another one. We have drop. You can see this one, drop base. Can you see it? Rally. Now what is this one? A what? A demand zone. And what do you notice? Price came back to that demand zone, and then what can you say? Just went up back. Now let's assume I placed a trade now here. When I see this pattern, drop base rally, what do I expect? I expect price to come back to the base. Now, where's the zone? Remember, it's a zone. This is the entire zone. This is the entire zone. This is the entire demand zone. Now, what do I expect? I expect price to tap into that demand zone, and I'm going to look for other confluences. I'm going to look for other confluences. Now, what can we notice? We can notice a 5 minute fair value gap. A 5 minute fair value gap. 5 minute fair value gap. I'm still going to be talking about fair value gap in more details, but just for you to understand this. Now, can you see it? Demand zone. This demand zone. Can you see it? Drop base rally. Now, what did price do? Price came back to that demand zone. Now, let's assume price has not yet come back. Let's assume we are here now, and we've seen this pattern, drop base rally. Now, what do we expect? We expect that price should go up, right? And we've seen this 5 minutes fair value gap. What do? We set a limit order, or we wait. We set a limit order at that 5 minutes fair value gap, because a fair value gap is most of the time an entry point for you. Or for example, now, like my strategy now, a Fibonacci retracement level, if we should draw it, look at where the 79 level is. So this is where the 79 level is. So that could also be your entry as well. It could be fair value gap, it could be retracement level. But most of the time, For example, now, how do I know that I'm supposed to draw this retracement level? As we've seen, price has broken this high here, which means price is in an upper trend. It's not in a lower trend again because it has broken this high here. It has broken it. So meaning, yes, I'm sure that price is going to continue in an upper direction or an upper movement. So we can see the pattern: drop, base, rally. Now what do? I just set a limit order, place my stop loss either below, little pips below the demand level, in case if price is, forming some whips or stuff like that. Then where do I set my take profit? To the nearest swing high. And where it was the nearest swing high? Right here. Remember that we waited for price to form this, and waited for price to come back, and to we are sure that price is going to come and hit this level because we know that price is going up. And since we are using retracement level strategy, like I said, is not, you can target more than zero. For example, now I can have like four more take profits. Like zero is take profit one, 0.24 is take profit two, 0.62 is take profit three, and zero and one is take profit three. And what do you see now? Price hits take profit four. I meant take profit four with a total of 420 pips and a risk to reward of 5.44 risk to reward ratio. Sorry, price was supposed to come from here. Now, sorry, I have adjusted this. Now, a risk to reward of what? 8. 1 is to 8 risk to reward. Meaning, if I risk $100 on this trade, I'm going to be making a total of $800. Now, can you see the power of this support and resistance and demand and supply? Like, you don't need to like force yourself and try to what is this that. No, just be cool about it. Like, try to understand. Like, that's why I said that if you know support and resistance, it's like having a glasses for the first time and you're able to like see properly. That's how it is. You're able to see the market properly. You don't need to overrush the process of understanding this. It will just try to go to the chart and look for all these levels. Like, just try to look for these levels. Just try to look for it, and you see, you understand it better. So now, this, like I said, these areas, they are usually formed by big moves. So if you see a sharp rally after price has touched a certain area, like I said, that's a demand. And if you see a sharp drop after price has touched a certain area, that's a supply. So yeah. So now, why do these zones actually matter? Like, who said that this is how the zone and that are supposed to be? Why do they actually matter? That's because banks and institutions, they trade in massive orders. They can't always fill all their orders in one go. So when price comes back to that zone, they continue filling and filling, and the reaction just repeats. So that's why it's you can we can follow them. We try to like follow the banks, the institutional traders. So now, go to any chart of your choice. I would prefer you go to gold charts and try to draw a supply and demand zone with exactly what I've already taught. Mark it with a rectangle tool and just show how price like return to react to that zone again. So yeah. Now the next one we are going to be talking about is trend lines and channels. So far we've already looked at horizontal levels, but the thing is that market does not always move sideways. They trend. That's where trend line comes in. And the funny aspect is that support and resistance is also in trend line. There's a trend line support and a trend line resistance. So now, A trend line is simply like a diagonal line that connects swing lows in an uptrend or swing highs in a downtrend. The rule is at least three touches to confirm a valid trend line. Like I already told you before about trend lines. So now let me try to draw a trend line for you on this 5 minutes time frame. Just go to your tool and you'll see this trend line, and then if there's three touches, then it's a valid trend line. For example, now this one is just two, it's not completely three. But if we should go to the line charts, we can try to see if it's three. If it's three, then it's valid, but if it's not, it's not valid. Let me let me go to an higher time frame and try to draw a more perfect trend line. So let's start from this low. Now, what do you notice? The line touches one, two, three, four, five. Price touches it five times. So this is a valid trend line. So that's just how trend line is. So when you add like a parallel line to the opposite side, you form a channel. So for example, now like this, then you now add a parallel line, you form what's called a channel. So if price is driving in this channel, then we say it's trend is a trend line ups what's it called? It's trending up in that channel. Do you get? But this one, I'm just trying to like show you how a channel would look like. But let me see if I can get a very very good example of a channel. Probably let me look for the tool. Trying to look for the tool. I think it just no. Okay, yeah, parallel channel. So something like this, yeah. But here, this is can be a very very good example of a channel. So I hope you understand um the concept of trend line. So like I said, the rule is that it has to be at least three touches to confirm that is a valid trend line. Now, in probably later lessons, I'm going to be when I'm teaching flipping and stuff like that under um risk management. When I'm teaching flipping, I might like do a short video of me flipping and showing you the strategy that I'm using, which is going to be this support and resistance and trend line. As easy as that. Like those two strategies, you don't really need more than that. If you want to like flip like crazy, you want to flip the money you can afford to lose, oh, not money you can't afford to lose, then you are good to go. You are good to go. Like I said, this trend line is not really a big deal. Just it's just like support and resistance, but it's diagonal. So just go to the charts, try to look for trend lines, trying to draw them, and you understand them. So the next one is breakouts and fake outs. Now this is where like most beginners where they lose money. Now you see price break above resistance, you get excited, you enter, and then before you know it, price reverses and then takes your stops. That's a fake out. It's your stop loss. That's a fake out. So why does this actually happen? It's because institutions, like I said, they push price above levels just to trap traders. You might think that, oh, price has already broke out of this level. Let me quickly enter the market. No, that's why we wait for retest. That's why we wait for retest. So retail traders, they buy the breakout instead of them to wait for the retest to know if it's a fake out or it's a real movement. Because if it's a real movement, then a retest is surely going to happen. And when that retest happens, that is when you enter the market, and that is when you're going to make money from the market. So, but then the market reverses, eating their stop loss, and the institution they take the opposite trade. So, how do you actually avoid fake outs? Like I said, you wait for a retest. Don't buy the breakout candle. Wait for price to come back and test that level as support. Like I already talked about in support and resistance. So you wait for the resistance to become support before entering, which is breakout and retest. So then look for confirmation like candlestick patterns like engulfing, pin bars, or rejection. I think I've talked about rejection um weeks at the retest. Then check for the higher time frame. And then if the breakout is against the bigger trend, it's more likely to be fake. Then you check the higher time frame. If the breakout is against like the bigger trend, then it's more likely to be fake. So now a quick exercise for you to just do is just quickly go to your chart, try to look for breakout and retest areas, and then like just try to repeat it, look for them, repeat it on different time frames. It could be 1 minute, it could be 5 minutes, it could be 3 minutes, it could be 15 minutes time frame, it could be 1 hour, it could be 4 hour. But if you like want to day trade, just stop at the 15 minutes. Don't bother going to the 1 hour, or just from 1 minute, 3 minutes, 5 minutes, 15 minutes. Just try to, you know, then retest and confirmation entries. Like I already talked, I think I've already talked about these retest and confirmation entries. When price breaks out of a particular zone, you must wait for it to come back to retest that level. So that retest is a confirmation entries. Other types of confirmation entries are candlesticks patterns, Fibonacci retracement levels, supply and demand zones. Like I've already talked about these stuff, and then fair value gaps, like I already said. And I think you should have already picked one or two lessons from what I've already talked about. So now let's talk about something sneaky but powerful, which is psychological levels. Now, humans, we love round numbers. Traders love round numbers. On gold, if you watch levels like, let me just go to the chart and show you exactly what I'm talking about. For example, now, price currently is $3,816.75. It's changing though. But let's assume it's on $3,817. That's a round number. That's a psychological level. What does that tell you? That price is going to, react very well at that level. It could be either your take profits level or your stop loss level. Like, do you get what I'm talking about? For example, now my take profit here is 3,819.902. But let's assume I round it up to 3,820. That is a psychological level. I'm very sure that price is going to hit that level. I'm very, very sure of that. So, because these prices, they are like magnets. So I mean, those prices, they are like magnets. Those ones, they are like magnets. Why? It's because traders places their stop loss and take profits at round numbers, like I already said. So it also acts as support and resistance levels as well. So banks know this, so they drive price into those levels to trigger what liquidity. I think I'm going to be there's a topic for liquidity and stuff like that. Let me check. After support and resistance, the next topic is indicator integration with price action, then news trading, risk management, trade execution, trading styles and strategy building. I think I've talked about liquidity, right? Have I talked about liquidity? Nah. Okay, I think it's not in this module. I think it's like if I'm going to like release a bonus module that I'm going to be talking about those fair value gaps, other blocks, liquidity concepts, more concept on probably more concept on that supply and demand and um what's it called? Smart money concepts. Yeah, smart money concepts. Where we have other block, breaker block. But like I said in the beginning that other people might call it different terms, but everything just rounds up to support and resistance. So yeah. So now let's just wrap everything up with a close. So support and resistance, they are the backbone of trading. Whether it's horizontal levels, supply and demand zones, trend lines, or psychological round numbers, these are the areas where the markets reveal its secrets. If you take nothing else from this course, remember this: trade with the levels and not against them. In the next lesson, we are going to be, adding another layer to our trading toolbox, which is indicators. But always remember price action first, indicators second. See you in lesson 5. Peace out.